Welcome to another Market Insight Call where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this month, as always, is Chris. But before we do that, I want to give a quick shout out to John and Catherine. They were in last week and we were talking about the Market Insight Call, and I had also mentioned what our outline would be. So John and Catherine, if you're listening, you can tell me whether I captured it or not, or if Chris has moved it so much. But I'll turn it over to Chris. Chris, why don't we just jump right in?
Yeah, the main question we're getting is why not sell? Why not sell your stocks right now? We've seen a 20% recovery in the market, and the first answer to that is you probably should sell if you have expenses coming up.
Right.
And our advisors have been reaching out to say, hey, let's refill our cash hubs. Let's get 15 months of expenses. Let's set it aside so we don't have to worry about if the market enters another drawdown. So the first answer is yes, you should if you have expenses.
But only up to the expenses that you need, right? We're not abandoning the market at this point.
It's a technical bull market. We do expect earnings to recover. There is a strong disinflation pipeline. Not my words. That's what Powell said yesterday at the FOMC meeting. And then we'll make a final comparison to the tech bubble and see, is this the tech bubble 2.0?
And there's a lot of banter going on in headlines on that.
There has been a lot. So getting into the S&P 500, this is a 52-week chart. So we can see circled in red is the lows of October. It's a 22% recovery from the low. That's why we're saying it's a bull market. You hear those numbers thrown around at 20%. 20% drawdown from peak to trough is a bear market. We recover 20%, you've now entered a bull market, even though we're still in this larger frame drawdown.
Right, the math may mean you're still not at a new market high, right?
Exactly, and the one thing I wanted to point out here is it's moved pretty quickly. As of recently, the last few months, we really have shot out above some previous resistance lines. You know, it's too early to say if that will turn into support and be strong, keep the market up here. You know, there's probably some fundamental reasons why maybe it'll come back down and kind of settle back in to where it was, still up significantly from the lows. But I just want to zoom back out and show exactly what you just said. Right? We're in this 20% recovery, but it's still a drawdown.
Right. And to me, this is looking like a normal, prolonged recovery where you still have headlines that are problematic. It's not the all clear, but we're climbing that wall of worry at this point for sure.
And it's probably not healthy to keep moving up as fast as we have.
No.
So we do want to start seeing slowdown. Probably wait for some fundamentals to come through. You know, we'll have earnings a month from now. Something to really help the market really digest what's been happening.
And I know you know technicals better than I do, but if I look at this chart, really to me we're back on the long-term trend. If I start at the beginning of this and I just draw a line, where we were out of the norm was the 20 to 21, 22 run-up where we got extended and beyond that trend line. This seems to be a healthy market, and what was unhealthy was the previous highs.
So to your point, reconsidering taking off some selling of some equities if we get back to something that's outside of the trend that you're saying, but we're still on that long-term trend when you draw a line back over 5-6 years.
Right, and people may say, well, why didn't you get us out in the high? Well, remember we did have 36 months of cash set aside at one point during that time frame.
Yeah. And so the question we're also running is, what does it look like historically? So when you're trying to decide if you have some cash to put to work, we talk about this at least every few months, dollar cost averaging versus lump sum. So I ran a bunch of scenarios looking back. I went back to the 80s, the recession of the early 80s, and I said, all right, if you have $1.5 million to invest, you can either put it all in, or you can dollar cost average over 6 quarters. And I said, all right, let's make the time periods similar to what they are now. So I waited till there was a 20% recovery in the market, similar to where we are now, put the lump sum in, that 1.5. That just shows blue line across the screen, 1.5 has been invested. Purple is the lump sum that was invested at the beginning versus the stair step. Orange is the dollar cost average because you're seeing money enter the market on quarterly intervals. And I know you know this one because we've seen this on almost all scenarios that we run. The lump sum outperformed, even after there's been a 20% recovery.
Yeah, this is one of those things where emotionally, or maybe there's that one time, it's really hard to find in the data, but you're almost always better off doing that lump sum than dollar cost averaging. But I would also say that emotions are a real thing, and one of the things we say is just get as much as you can and let's dollar cost average as best we can in the short amount of time. But every time, no matter how we slice this, looking at real data, looking at clients' accounts, looking at hypotheticals, it's almost, and I mean almost always, 99% of the time, better to do lump sum.
Yeah, and I spent a bunch of time running these. I ran 4 scenarios of the last, strong bear markets that look kind of similar. I should have just went to LinkedIn because Ryan Dietrich, someone we show a lot, a market technician over at Carson, he had already done it. He ran it slightly different than I did. He didn't dollar cost average. He just looked at returns after you've seen the same thing I was doing. After you've seen a 20% recovery, what do returns look like in the 1, 3, 6, 12 month to the right? A lot more green than red.
Right.
Like you pointed out, there are scenarios where there is red, and this could end up being one of those, but the vast majority of them shows up green.
Right. The market is a forward-looking machine. It's already projecting in all the bad news that we have, and it has built in a price to move up. And almost all the time, you're better just to put the money in. And there is this one thing. What I would say is that's 2000. It's not 2008. 2008 was the worst correction. Right? That was the Great Recession. 2000 was rough, but it's 2000 that shows up because it's an anomaly.
Right. And this is Ryan's favorite type of charts. To our first actual chart we showed, which is the 52-week high, he ran the same thing, but looking at 52-week highs when you haven't seen one, that was even more bullish. There were 12 months. Everything was green once you're hitting that new 52-week high. And we will pivot to fundamentals here. I just had one more technical measure just because we've been talking about breadth a lot, which is just participation. Are a bunch of stocks participating in the rally, or is it the mega cap 7, which is what everyone on TV is talking about? Because it has been.
So it's no longer the FANGs, right?
Right. They've added a few more. NVIDIA didn't fit into the original FANG, but they had to add that to get to the mega 7. Well, we could look at the S&P, which is going to weight those by market cap. Mega cap's going to have a stronger weighting to the large cap, and the equal weight RSP is going to only be 20 basis points for each security, as it has to get all 500. And we'll see very short time period, 2 weeks, the RSP, the equal weight, is outperforming.
Right.
So we're seeing a little bit of a catch up in some of the smaller names, but again, not really healthy to moving up 4% in 2 weeks. That's not sustainable to get half your expected return in a couple of weeks. But it is good to start seeing that there is some equal weight participation across stocks.
Right, I would say a lot of this is probably that AI component. With NVIDIA, clearly the AI, but Microsoft, Google, all these information things where AI is probably going to add a lot of profitability. It's showing up there first because those are the ones that are going to first be able to scale. And we're seeing those in the earnings surprises on a lot of these companies. But to your point, it's got to make its way down to the smaller cap. So this time, it's good to finally see some of that. On that. Do you want to talk about earnings?
Let's look at earnings just quickly. Similar slide to what we've been showing, except we updated it with the most recent. Q1's been closed out. That's the circled and squared off in red. We have negative 2.8% earnings growth. That is the actual number. That's why you see the A next to there. That's what happened. The next few numbers are expectations. The left is Yardini. Tends to be more bullish than consensus and tends to be more correct than consensus. He's been very right on a lot of these numbers. He's looking at this current quarter that will start reporting in 6 weeks or so, negative 5% earnings, and consensus is still seeing negative 8. So when we look at what can help, what would bring the market down fundamentally, as we get into this earnings season and companies start to miss and guide down. They start saying, you're expecting earnings to be flat Q3 and start growing again in Q4. If they start saying, no, that's not going to happen, that's when we would get worried, right? That's where the fundamentals will not be able to catch up to this large technical move that we've seen.
But if we look back last quarter and talking about NVIDIA, you get these surprise earnings. Well, if they're the largest companies, they're going to have the largest, I know it's rough math, but they're usually going to be the dominant part of the earnings. So if we continue to see surprise earnings from this new technology and the economy that we're in, I don't think it's not a horrible prediction to say earnings continue to move up above expected, really.
Do you want to take inflation?
Sure. So whenever we look at the Fed funds rate, we just had the pause that we may get 2 more. But one of the things that hasn't happened in a long time is now the Fed fund rate is above inflation. So this is actually a healthy market. We haven't been in a healthy market for quite some time. And I would argue that if we can maintain the Fed funds rate above inflation, then we'll see a lot less volatility going forward and a more smooth application. Now, we're not going to have the big jumps that we did before based off of that, but this is not an anomaly. This is normal, and I'm glad to see inflation. I would also say one of the things that we've talked about, remember we were early on saying inflation was going to be a lot worse coming out of 2020 with the amount of monetary stimulus that came out. We were accurate. We said that it would continue to move up early to about mid last year. We were saying because of the way shelter was impacting it and the way that that's calculated, and that's continued to be accurate. And I would say that if you looked at just what's happening in the inflation front and you took shelter out, this number is still a little high because of the way that shelter affects CPI. So I think Powell is right that we are starting to see that disinflation component in the market. And to me, I'd even go out on I know we're going to jump in on what how hawkish the Fed still is with their 2 additional rate hikes that are possible. I think if we continue to see inflation go down, they're going to say, hey, we've already actually raised rates because the spread, the real rate, has expanded since our last meeting. You want to go to the next slide?
Yeah, that's a good point. And so far with what you said, and these are just projections, and as Powell points out every single time, he wants you to look at the short-term projection. He says there's too much uncertainty to look at the long-term, but they want to try to get a hold of where short-term rates are going, at least now. And there are 2 members that agree with you. They're in that bottom range, 5 to 5.25. That's where we stand right now. Mm-hmm. 2 members said that, hey, we're done. We have 4 that said we'll probably do 1 more. And now the median dot, which has raised, the median used to be right where we are now, at 5 to 5.25. Now they're saying, now there's probably going to be 2 more between now and the end of the year. So that could be a headwind for stocks, right? We've seen this strong rally, and the market did not expect this. This is new information as of yesterday that they're going to have to price in. And of course, there are still a lot of people saying exactly what you're saying, which is it's probably not needed. So there's a chance the market can shrug it off pretty quickly, but that's going to be kind of that headwind we see between now and the earnings.
So this is actually something that can continue to push the market up. One, we've just priced in these rate hikes. So that component is now priced into the market. If they were to not do that, we're going to see an elevation in the market just off of that news. So, right. And I could see that CPI continuing to come in low, or our indicators, that actually starts to change the probability.
You pointed this out last month, which is we've already come so far, right? 500 basis points. The market could also be thinking, what's 2 more? Right. It's from here. It's now how long are we going to stay rates this high versus are we going to have 1 or 2 more rate increases? Right. And when we look, this is what we're talking about: pricing of the next rate hikes. This is what the market's going to keep doing, and this is going to change a lot between now and their next meeting at the end of July. But right now, the market's saying probably about 72% chance that they're going to raise and not stay paused right now.
So I'm actually going against this, right? I'm on the limb here. I'm disagreeing with the market. The market agrees with majority of the people that do raise the rates.
Exactly.
So they're saying 70% likeliness, which I think is, once again, you can make a bull case out of this. Mm-hmm. And to your point on what's a couple of rate hikes on 5%, well, it's a lot different whenever you're talking about stock math, whenever it's a couple of rate hikes on 1%. Right? This is not going to have as much of an effect on the way that you value stocks because interest rates, as a ratio of change, it's becoming less and less each time they raise rates.
Let's get into that tech bubble comparison. We'll start with NVIDIA, which has really just been the spark to keep the tech market higher. On the left-hand side here, we have straight from their earnings presentation. This is revenue. So we'll see green is what they reported, $7 billion in revenue. They can be compared to Q1 of the year before, where it was $8 billion, right? They had a decline in revenue, but they surprised and guided that the next quarter is going to be closer to $11 billion. So when you compare that $11 billion to where it was a year ago at 6.7, it's something like a 60% revenue growth rate on that quarter. We saw a 30% jump up in the stock, right, because of this strong guidance upward. We can look at the right-hand side as earnings expectations from the analysts, looking out more than just 1 quarter, right? You have to look out the next 2 years. The first part is earnings. We can look at the bottom one. Let's look at earnings per share, and that 3.3 is a little bit generous on a backward looking, but the market and analysts are expecting that to grow to $9.5 per share 2 years from now, which is a CAGR of about 70% earnings growth over the next 2 years. pretty significant earnings growth is getting priced in now.
Right, because it's always priced on future earnings, right? And you could say, well, it's too expensive. It's gone a long way, which it has. But if these are realistic numbers, it's priced correctly. And going back, you say, well, it's priced at a higher price, and its earnings are actually lower than it was in Q1. Well, that makes the likeliness of having higher earnings greater, because they've already had earnings that were above that previously, and we're further on in the market with a lot more growth, especially with a lot of this AI technology, with all the new chips that are being sold for the new products.
Right. And this is the kind of the part that you and I disagreed on a little bit, right? I saw getting a little bit above 400, the PE ratios just from these earnings alone, it's too high. If these earnings are correct, right? Like you said, they could beat these earnings, right, grow into the current multiple, and so far, me saying it was overvalued at 400 as of now was wrong. Stock went up 9% more and went to 430. Of course, it can pull back from then. But it's really going to be what we've been talking about, which is, can these earnings materialize? If not, there's going to be a sharp recovery if you have to start repricing in earnings that are significantly lower than these high expectations.
Right. So I mean, you're pricing in the growth of the stock, and if it's reasonable and likely to be achieved, which the market thinks it is, then you're gonna pay a high PE. The thing is if it's not achieved, then there's a lot of downward movement. So we've been in the video for a while, and you want to be early in on these. You don't want to be necessarily adding to positions here at this point. But I think it's a reasonably priced stock. Could you make the argument that it's kind of rich? Absolutely, you can, but not whenever you consider the growth. It's how much risk do you want to take for this stock.
Let's move to our tech bubble comparison, just with price to earnings ratios. So a lot of people are saying this time similar to the 90s, late 90s, and there are certainly some comparisons, the way .com was used in companies' names, and now AI, the mentions, you could chart those. They're very, very similar. But when you look to just price to earnings ratios, it was very different. There was this run up in price to earnings ratios on the left-hand side in the 90s that pushed the growth index up over 30, 40 times forward earnings. Right now we're at 21. Which is elevated from a 10, 15 year period. It is. It's right around the average of the 5-year, because we had some strong moves in 21, but elevated in the short term, but nothing compared to what we had in the 90s.
But we're also coming out of a market downturn, which whenever you come out, PE ratios are always high because earnings got squeezed. So once you're starting to get back to, hey, we're going to go back to normal growth, you're going to pay higher for PE. So you can certainly defend, hey, we're about average PE coming out of a correction. So there's two stories to this, for sure.
I did just want to make, that was at the index level, right? We can look at some of the names inside that had some of those large moves. Instead of using some of the earnings measures, which can be difficult at the stock level, you can look at enterprise value to sales, just the size of the company and the sales that they're doing. And we can see those ratios back in the 2000s on the left, 28 to 48 on the highs. Well, right now, when we look far to the right, we're seeing 3 to 7 to 11, and NVIDIA is that pink-purple outlier.
Right.
It's the one outlier that's significantly higher than some of the other large-cap tech names like Microsoft that's at 11, or further down with Amazon around 2.
And once again, we've made the case that I think you can argue for NVIDIA, it could be a justified valuation, but what it's not is systemic. It's not across the entire tech industry. A lot of these companies are trading at very attractive rates historically.
Yeah, and they haven't even reached their own rates as they have in the past 2 years. And I'm not saying that we're comparing the last 2 years and that price was absolutely correct,
right,
that they were overvalued. Now, Microsoft's been in the portfolio since 2019. It's been our top pick since 2019, our largest position. So we obviously follow it very closely. And when we look out and we price back out what we're expecting, and again, it could beat our expectations, it's pricing out almost exactly at the current value right now, meaning it's priced for its cost of equity. So if our numbers are correct, we'd expect Microsoft to return what you're expecting, right? That 9 to 10% return.
The market return.
Right. And if it starts to beat above that, well, it's undervalued and you'll get excess return above those. But we are starting to see that some of them are more right in line with our long-term expectations. Again, the same trend with, we need to hit those expectations or beat them. Mm-hmm. That's really the risk.
I totally agree. I would also say that Microsoft is a big invested heavily into AI. and they have new releases called Copilot that's coming out that may increase subscriber, certainly could monetize things. So there's a bull case just on the typical AI. And I would say that most CEOs are saying that as much as they can on their call because they know the algorithms are looking for that because they've made a correlation with the word AI with stock price increase. So there's a lot of gaming that's going on in there as well too.
Yeah, I know Adobe reports earnings today. If they're not mentioning AI,
why would you not mention it?
They'd have to get rid of the CEO. I just wanted to make two final comparisons to the tech bubble, just to show that we've had a nice recovery, but it's not the same, at least yet. And so we can look back. Just did a 5-year trailing from today. Grab the 3 kind of cycles we see. This is the Nasdaq recent chart, 162% off its low from that little rate hike scare we had at the end of 2018, 140% from the COVID low, and then there's that 32% on the far right, peak to trough we've seen in the most recent cycle since October. So great returns, but when you compare it to what happened in the tech bubble, and same thing if we used a trailing 5 from this time period, there's almost a 500% cycle that started in the mid 90s, followed by 260% return, and then the latest one was about 90. So if we're looking at scale, they're pretty different.
Yeah, very different. This is one of those things that it's really painful to invest in a bubble in the late stages. It's great if you can be early on. I don't know whether AI becomes a bubble or not, but if it does, we're in the early phases, and that's okay. You want to invest at that point, and hopefully our signals and our process and our strategy pushes us out if we do get into bubble levels to go elsewhere. Any other things that you want to add?
That's everything I wanted to hit.
Well, I do have sad news to report on. Ted McDonald, who is the author and really an inspiration to us in the investment committee as well as the overall Gatewood Wealth Solutions company, he passed away this week. So that is with a sad heart to say. One of the things that we're doing is we're putting, as a tribute, we did an interview with him where we discussed his investment strategy. So please go out there and look at that. Now, not to end on a sad note, the good news is Claire and Chris will be welcoming their first yet to be named or yet to be disclosed named child.
Yes.
So if you can hit the like button, for every like that we get, we'll make a contribution to the college fund. So make sure that you're sharing it so we can get a lot of likes, because inflation, whether high or low, college is always expensive. So please subscribe and send that link, and we will see you next month. Thank you.